Hi, and welcome to this edition of the Options Learning Center. My name is Rick Orford, and I've been a stock and options trader since 1999. And today, I'm excited to show you how to sell short call butterflies and use bar chart to get the most out of the strategy. The short call butterfly spread is a directional option strategy that involves 4 call options, 2 of which are at the same strike price on the same underlying asset and with the same expiration date. This strategy works best if you anticipate the asset will trade with higher volatility by expiration. For example, you might trade this strategy right before a big announcement like an earnings release. The trade will hit the maximum profit condition if the underlying asset's trading price ends outside the outer strike prices at expiration. To set up the trade, you'll sell 1 call at a lower strike, buy 2 calls at a middle strike, and sell 1 at an even higher strike. All options share the same underlying asset and expiration date, with strike prices equally spaced. The result is a bull call and a bear call spread that results in a net credit. The goal of a short call butterfly is for it to achieve maximum profit, and it'll happen if the underlying asset's price trades outside the short strike prices at expiration. The maximum loss occurs if the asset's price settles at exactly the middle strike price at expiration. Now, let me show you how you can find short call butterflies. The first step is to go to barchart.com, then click on Options, and then click on Short Call Butterflies. After that, you'll be taken to the results page where you'll immediately see some potential short call butterfly trades based on default filters. Here, you'll find essential trade details like expiration dates, strike prices, premiums, maximum profits and losses, and of course the probability of loss. Now, these default results are already in their maximum profit condition, as the underlying securities price is currently trading below the lower short strike. The probability of loss is also very low. Now, you can also arrange the columns by clicking on any heading. For instance, I'll click on a couple of headers here to sort them from highest to lowest and vice versa. Now, if you want to adjust the search parameters, click on the Set Filters here at the top, which will take you to the Options Screener page. On the Screener page, you can type in your desired filter into the Add Filter field and then click on Add. If you're unsure what to add, click on the drop-down and select an option. Available filters cover stock and options data, including options analysis, underlying prices, trade details, company earnings, technicals. Basically everything that you need to fine-tune your trade is right here. You can also remove any filters that you don't need. Now, the rest of the values appear by default and serve as a very good starting point, but you can adjust them. For example, I'll add ETF here to the security type. Then, I'll scroll down to the probability of loss. As the name implies, this filter shows the likelihood of losing on the trade even by 1 cent, which to me is arguably the most important filter here on this list. So for illustration, I'll set this to 20% or less, and then I'll click on See Results. And here we go. Now, I'll sort the risk-reward column from lowest to highest. And then I'll go with the top result right here. Now, before I explain the trade, did you know that you can save your screener to reuse it later? If you want to do that, just click the Save Screener button right here at the top, then type in the screener's name. At the bottom, you can also have Barchart email you at a specified time with your trades. It's that easy. Now that that's done, let's move on to the trade example. According to the screener, you can set up a short call butterfly spread on the SPY with the ETF currently trading at $580.01. And here's how the trade would work. You start by selling the $588 strike call, collecting a premium of $7.37 per share. Then you buy 2 $599 strike calls, paying $3.16 per share for each contract. Finally, you sell the $610 strike call, collecting $1.06 per share. This setup results in a total net credit of $2.11 per share, or $211 total for one spread. Your maximum loss on the trade is $8.89 a share, and all options expire on November 29th. And the trade has a 19.7% chance of probability of loss. I find it's best to know the break-even points on the upside as well as the downside when monitoring the trade. And bar chart gives you the break-even points. But if you want to calculate it yourself, add the net credit to the lower strike to get the downside break-even. For the upside break-even, subtract the net credit from the higher strike, and that gives you the break-even points of $590.11 on the lower end and $607.89 on the upper end. If the price of the SPY ETF moves beyond the short strike prices in either direction, you get to keep the maximum profit. The maximum profit is calculated by subtracting the premium paid from the premium received to set up the trade, which works out to $2.11 per share, or $211 total per contract. However, if the price of the SPY ETF stays between the short strikes and ends at exactly the long strike at expiration, you'll hit the maximum loss condition. This is calculated by taking the difference between the short strike and either of the long strikes, also known as the width of the spread, and subtracting the credit received. For this trade, it works out to $889 per spread. Here's a profit and loss chart with different prices at expiration to illustrate how short call butterfly trades could work out. As you can see, maximum loss occurs only if the SPY trades at exactly $599 at expiration, and transitions from a loss to profit as the underlying security moves beyond the break-even points. The maximum profit occurs when the underlying security trades beyond the short strikes at expiration. So that's screening the entire market for assets to use in short call butterfly trades. But what if you have a specific stock in mind? Well, that's also easy, and I'll show you how. If you aren't already there, let's go to barchart.com and then search for the asset using the search bar. For example, I'll look for Micron here. Once on the stock's profile page, navigate to the left and look for butterfly spreads. Then, click the Short Call Fly tab, and you'll see some default trade results. You can click on the drop-down to change the expiration dates, change trade legs, rearrange each column, or click the screen link right here, then the Set Filter tab to access the Options Screener page for a more granular search. It's really that easy. Now, it's always a good idea to close your positions right before expiration when using any strategy that requires writing or selling options. For this example, you have two short positions in the trade, and if either is in the money at expiration, the option will be automatically exercised, or in your perspective, you'll be assigned. If either of the short calls do get assigned, you're obligated to sell 100 shares of the stock for every contract you wrote at the strike price. And this means that you might need to purchase the shares at the current market price, which could be higher than the strike price, and then sell them at your strike, potentially resulting in a loss. You may also sell the long call positions to capture any remaining value, which could mitigate some of your losses if they haven't already expired. But do keep an eye out for trading fees, as it may not be worth it. Short call butterfly spreads require very little capital, as they start with a credit. Like all spreads, they have a defined profit and loss profile, making them great for risk-averse traders. Also, you don't need to predict which direction the underlying asset will move, since both directions could lead to a profit. And that makes it excellent for high volatility trading environments. The short call butterfly, like all short spreads, has limited profit potential, and it can require significant price movement in the underlying asset depending on the width of the spread. This strategy is also highly sensitive to time decay, especially if the asset's price stays near the long middle strikes. Additionally, transaction costs in multi-leg spreads can reduce profits, so monitoring these costs is essential. The short call butterfly is an excellent strategy in high volatility situations where you can't guess which direction the asset will move. However, it often requires significant price movement to profit and has multiple trade legs that can lead to high trading costs, further impacting your profitability. So to maximize your strategy and the profits, you need to keep a close eye on your trades and use resources such as trade guides and bar charts option screener. That way, your efforts won't be wasted. If you need more information, don't hesitate to visit the Options Learning Center, where you can learn more about this strategy, as well as all of the other options trading strategies broken down into their working parts, so that you know exactly what you need to do to trade them.